Topic 11, like Randy said. Topic 11 is assets, liabilities, and net worth. And topic 12 is protecting assets. We're fortunate to have Lisa Emerson and Carla Martinez from the Oregon Division of Financial Regulation. Today, they're going to speak to the group about insurance. And as always, we're going to spend some time learning and reflecting on the economic systems that we all operate in to understand the complexities of these systems better. We believe that this will strengthen the way we approach IDA financial education. The images here are the pages from the complete IDA financial education standards, which we'll encourage you to review if you haven't seen those yet. And I'm going to go ahead and paste the link in the chat in case you need the link again.
All right, so we are going to start with net worth and wealth, which are often used synonymously. We're going to spend a little time talking about calculating net worth as a benchmark tool, the ways in which wealth is conferred and extracted to and from groups of people, and also redefining wealth as a concept. The last few years, there's been more attention paid to the growing wealth gap in the United States. Before we delve into the details, let's clarify the definitions first so we're all on the same page. The mainstream definition of wealth is a simple calculation of your assets minus your liabilities. This definition centers financial assets and private ownership to the exclusion of everything else. It's also important to note that wealth and income are not the same. Julie will circle back to that in a moment as well.
So simply based on the definition that Luke gave, some financial educators use net worth as a learning tool by having participants inventory, value, and calculate their assets and subtract their liabilities. People typically are advised to complete this calculation on a yearly basis in order to gauge their progress towards accumulating assets and paying off debt. I have found that many people are reluctant to do this calculation, partly because they're worried that their numbers are going in the wrong direction. But just like a dashboard in your car gives you good information while you're driving, the net worth calculation gives a macro view of how a person is doing financially. So in the chat box, could you please tell us, do you encourage your participants to complete the net worth calculation on a regular basis? And if so, which tools or methods have you used that help make this calculation accessible and useful? I also want to say, if you're feeling like you would rather share verbally instead of typing, please go ahead and unmute yourself and share. Okay. Nate says he does not do this regularly. Folks want to chime in? Okay. Interesting. Okay, so not on a regular basis. Do it with them at the beginning and at the end of your time. The IDA tools. Adriana, I'm guessing that you're saying the IDA, like the net worth calculation during the asset calculation when they apply. Okay, we track debt, but not assets. Okay, Dev Northwest uses it on their application, do not require it regularly. Okay, so that's an affirmative from Adriana. Okay, all right. So it seems like it's not a tool that everyone's using. And I'll ask you to consider kind of introducing it. Of course, as you know, this isn't something that's required except for when they're applying for the IDA. But this is the form that folks have to use to calculate their assets and their liabilities in order to qualify for the IDA program. So they're already doing it in the very, very beginning of the program. And so there, probably other tools out there, but since this is something that they're already required to do, one of the ideas or suggestions that we have is possibly having, because this is actually, Luke, correct me if I'm wrong, this is a spreadsheet, correct? It's electronic.
No, it's, I mean, people may offer it in different ways, but mostly I'm guessing people are either doing it on paper
On
or,
paper?
yeah,
Okay.
and then it would be up to the provider or the participant to actually do the calculation. It's more just the filling out the field.
Okay. Okay. So to put a couple of extra paper copies in their file and put a reminder in your calendar, your electronic calendar on an annual basis, to send it to them by mail. And even though it's not required to collect this information, it might be really valuable information for your organization to have just so that you can kind of gauge their progress as they're coming along in the program, and it helps get them in the habit of actually completing this on an annual basis. Um, you might perhaps even encourage folks by offering a small incentive, maybe a little gift card for a local vendor neighborhood store that you want to support. So again, it's not required, but it's a helpful tool. And we encourage you all to kind of either consider it or look into other things that you think might work a little bit better for your program. So next slide. So why do we differentiate between wealth and income? Well, the census formally defines income as money received on a regular basis, exclusive of certain payouts such as capital gains. And by this official measure, the wealthiest families may have low income, but the value of their assets earns enough money to support their lifestyle. So dividends from trusts or gains in the stock market do not follow under the definition of income, but are the primary money flows for the wealthy. Many of the CEOs from the largest corporations draw a relatively small salary, and an overwhelming share of their compensation is in the form of stock options. Some retired people also have little income, but usually have higher net worth because of money saved over time. Remember back a couple sessions ago when we shared about how the wealthy access security-backed lines of credit. Money borrowed against these securities is not considered income. In 2021, the richest 10% owned 88% of all stocks and mutual funds, and close to 2/3 of that was owned by the top 1%. 47% of residential real estate is owned by the top 10%, and 1/3 of that is owned by the top, I'm sorry, the residential real estate is owned by the top 10%, and 1/3 of that is owned by the top 1%. Now I'd like for you to close your eyes and imagine a scenic river. Think of your income like a river, a flow of money that's added to existing reserves like from a job. Wealth is like the reservoir, a reserve that can be tapped into when needed. But since we're covering topic 11 today, we're focusing on the reservoir and the ways in which our policies have affected the existence or the size of the reservoirs. In the US, the 10% earning the highest incomes take home nearly half of all income, but they own more than 70% of all the wealth. The average wealth of the top 10% was $6.8 million. That's the average. The bottom 50% made 13% of all income and only 1.5% of total household wealth. The average wealth in this group was $48,000.
So in general, the wealth disparity between the top 10% and the rest of the population is severe. However, when we look at the racial wealth gap, the numbers are even more alarming. You may have seen this government boosts and blocks to building wealth graphic before. We're gonna put that in the chat. Let me put that in there really quickly so you can reference it as we read along. But in this particular resource and graphic is charting the various policies and practices that have impacted different populations. The lighter band in the blue to the right above the center is what we refer to as the wealth starter kit for white people. And these policies and events in blue have contributed to the accumulation of wealth for the general white population. And of course, there have been white people who aren't able to benefit from these specific events or policies, and were individually discriminated against based on class, or some other reasons. But at the same time, however, the magnitude of the institutional betrayal of Black, Indigenous, and Latino people at the hands of our government has been enormous. These policies and practices, even long abolished, have continued to act as an ultra boost that hampers their ability to generate wealth. And so Black people who were enslaved, segregated, and then excluded from government-backed home loans, indigenous peoples whose land was stolen. The government forced indigenous populations and peoples to farm on suitable land, and when they didn't, the land was confiscated. And beginning in 1953, were forced to liquidate their assets and sell their land to private companies, resulting in widespread poverty in indigenous communities. And then following the Mexican-American War in 1848, Congress passed the California Land Act, referred to as CLA, that failed to honor the treaty of the Guadalupe Hidalgo, which resulted in the loss of private property from Mexicans to white settlers. And starting in 1954, the director of the United States Immigration and Naturalization Service used military tactics to remove over 1 million Mexican immigrants, some of them American citizens, from what we now call the United States. These apprehended were often deported without receiving the opportunity to recover their property in the United States or to contact their families. And the relatively low cost of our food comes from at a high price of chronic instability for Latinx immigrants working in agricultural sector. And it's all sanctioned by our government through programs like H-2A, agricultural worker visas.
I'm going to take a quick moment because that was a lot of trauma covered in a short period of time. So next, I'm going to talk about the current racial wealth gap, but I think in this slide and the slide before it, we see how particular policies were racialized, how race or ethnicity was tied to particular oppression or exclusion, and these are just a few examples. So when we think about the current wealth gap, there are a few ways to look at it. There's either looking at the median or the mean. Here we're looking at the average. So if we think on average, Black families own about 24 cents on the dollar compared to white families. Hispanic or Latinx are about 23 cents on the dollar for every white family, or the average white family wealth. And Native American or indigenous communities own roughly 8 cents for every dollar when compared to white wealth. It is less common to see figures for Native American wealth because the data is less available in general. And so you'll often see, we had to actually dig for particular numbers. So Julie, I don't know if you can share the links to those, where those came from into the chat if people want to look at that. Again, you'll see it represented different ways, and particularly what I've noticed is sometimes you look at the mean and sometimes you look at the median, and that shows different metrics when you compare the racial wealth gap through the lens of race. So we do want to be clear about why this gap is the way it is. It didn't just happen by accident. Looking at wealth through the lens of race helps us understand the long-term financial effects of intentional race-based exclusion or exploitation. So there's a couple more examples. You can draw on the Boosts and Blocks document as well. But here's some examples of groups that were not only oppressed, but there was theft and land and labor, systematically excluded from wealth building opportunities that white people, specifically white men, were afforded. So here's some of the larger, maybe more significant ones: land grants to people moving west, gold rush land claims, Homestead Acts, GI Bill, federal housing loans, Social Security benefits, and minimum wage laws.
So today we're going to shift our focus from systematic exclusion to something called predatory inclusion, a process wherein lenders and financial actors offer needed services to marginalized households but on exploitative terms that limit or eliminate their long-term benefits. We're all familiar with the myth of the American dream, where if you work hard, you can achieve anything. Along with this narrative is that if you purchase a home, that the purchase of a home is key to building wealth, and getting a college degree will help you get a well-paying job. For most of the 20th century, this was true for white people who reaped the benefits of the wealth starter kit. For many non-white people, the acquisition of these assets has resulted in significant wealth extraction. Most of us have at least heard of the term redlining and have a general idea that racial minorities, particularly Black people, were prohibited from obtaining loans from banks in neighborhoods they lived in. The mainstream narrative framed banks as private actors in perpetuating racial prejudice. In actuality, a combination of actors contributed to the redlining, but the most egregious offender was the Federal Housing Administration. The FHA's refusal to insure loans in Black neighborhoods accelerated the decay and isolation in these areas. Not only were most Black families locked out of buying or renting in white suburban neighborhoods, the ones who could afford to buy in Black neighborhoods could not access an affordable FHA loan. The FHA's underwriting manual and other official technical guidance memos demonstrate how racialized segregation via housing was an intentional policy. The manual and other documents included directives stating that incompatible racial groups are not permitted to live in the same communities, explicitly mandating racial covenants that legally prohibited homes from being sold to Black people and other minorities, requiring all lenders to keep color-coded maps, the red line maps, to guide loan approvals. In her book, Race for Profit, Keeanga Yamada Taylor details on how the passage of the 1968 HUD Act, with the passage of the 1968 HUD Act, the banks and the real estate industry shifted from excluding Black people to profiteering from them. So before 1968, housing discrimination was widely accepted and ingrained in both public and private institutions. And so, as mentioned in previous slide, the FHA's underwriting manual stated incompatible racial groups are not permitted to live in the same communities. The American Institute of Real Estate Appraisers wrote, "The clash of nationalities with dissimilar cultures contribute to the destruction of value. When a new class of people of different race, color, and nationalities with dissimilar cultures move into a neighborhood, old inhabitants think that the neighborhood is losing desirability." And then there's the National Association of Real Estate Boards, which promised to punish and revoke membership to any broker who disrupted patterns of racial homogeneity on a given block or neighborhood. Mainstream mortgage lenders helped create the color-coded maps and then refused to underwrite loans in redline neighborhoods. Black people were trapped in neighborhoods with dangerous rodent-infested housing, largely owned by white people and institutions. The conditions sparked activism and urban uprisings. Activists chanted, "Rats cause riots." Shortly after the assassination of Martin Luther King in 1968, the Civil Rights Act was signed prohibiting discrimination concerning the sale, rental, and financing of housing based on race, religion, national origin, and sex. A few months later, President Johnson also signed the HUD Act. Prior to this time, the federal government had committed to housing low-income residents through building and renting public housing. The HUD Act allowed the government to pivot through using private markets and ownership in order to shift much of the costs and burdens onto individuals. Their goal was to turn low-income renters into homeowners in an effort to lower costs for the government and to quell civil unrest. So written into the HUD Act were two programs, Section 235 and 236, which enabled participants to buy a home with a $200 down payment, a 20% income paid to the mortgage, and a capped 1% interest rate. And for the first time, federal mortgage insurance. The federal government guaranteed the loans in case of foreclosure or abandonment. This one action removed all the risks from the lenders and made people previously shunned into lucrative targets. The program ramped up at a time when costs to borrow were becoming prohibitive due to high interest rates and for those who had to borrow mortgage money on conventional terms. Speculators brought cheap, dilapidated properties, hoping to flip them to people who qualified for these new programs. Federal appraisers took bribes to inflate the value of dilapidated houses by 3 or 4 times their actual worth. Realtors made commissions by misrepresenting the conditions of the properties to inexperienced homebuyers who were told that the homes passed FHA inspection certifying habitability. Bankers made the money at the front end, securing the loan, and then again at closing when the bank sold the loans to the secondary market for a risk-free profit. Single Black mothers who were ensnared in the scheme filed complaints and lawsuits and were eventually invited to testify in congressional hearings. Their testimony sparked congressional investigations into these homeownership programs. Local FHA officials, appraisers, real estate agents, and mortgage lenders were arrested and indicted for criminal conspiracy to commit fraud. By 1974, 28 HUD officials had been indicted for their role in the scandal, and the FBI had 1,930 additional open investigations into fraud in the HUD housing programs. So even as hundreds of white men were arrested and indicted for criminal acts of fraud, corruption within the HUD homeownership program, George Romney, the Secretary of HUD, this is Mitt's dad, at the time insisted that housing by itself cannot solve the problems of people, particularly those who may be suffering from bad habits, lawlessness, laziness, unemployment, inadequate education, low working skills, ill health, poor motivation, and a negative self-attitude. Participants of the 235 and 236 program were sold homes that were neglected by private and public institutions for years, and then when the homes were determined to be uninhabitable, often a short time after the sale, politicians and the media used the failure of these home purchases as evidence that Black buyers should be considered risky and pose a threat to the quality of the neighborhood and its property values and should be treated differently in the real estate market. President Nixon used this HUD crisis to pivot towards the new Section 8 housing voucher program that divested the federal government from low-income home ownership. The objective of profit-making outpaced the necessity for safe and sound housing. The end of explicit racist exclusion ushered in a period of predatory inclusion where segregated housing market continued because it was profitable. Fast forward a generation later, and the 2008 subprime mortgage disaster was a result of the banking industry preying on Black and Latinx borrowers by aggressively marketing high interest and high fee loans and lax oversight by federal regulators. Again, these were federally insured loans that were able to be packaged into credit default swaps and traded on the stock market. Predatory inclusion stripped a generation's worth of wealth from the Black and Latinx population. The bottom 90% have most of their wealth tied up in their homes. Homeownership is a tool for wealth generation for some, but free markets are not neutral. Wherever Black people live create value for where they are not present. The policies of HUD, the FHA, bankers, and the Realtors and Appraisers Association heavily shaped the real estate market by using profit and fear as motivators. Though the exclusion policies have long since been officially rescinded, their impacts can never be erased. They have shaped our physical surroundings and created an immense wealth chasm that no amount of individual hard work can correct on a societal level.
So again, just want to take a moment to pause and take a couple of deep breaths, and as we often do in the other space, to breathe through a lot of the trauma as we acknowledge how systems in their infrastructure and through the legislation of race adversely impacts the lived experience of individuals, specifically in this example, Black individuals and also Black, Indigenous, and Latinx communities at large. So earlier this year, in the session on topic 7, we touched on student debt and the skyrocketing cost of higher education. And after the passage of the 1965 Higher Education Act created financial aid and student loan programs, taxpayer funded support for public colleges and universities started to recede, as well as the establishment of larger for-profit publicly traded schools like the University of Phoenix. In 2010, Phoenix alone reaped $1 billion from Pell Grants, along with $4 billion from federal loans. Back then, a quarter of all federal aid went to for-profits, while they enrolled only 10% of students. And for-profit schools have targeted older Black women who are more likely to be single mothers. And in for-profit schools, also charge twice as much as a public four-year college and 4 times the amount of community colleges. And students at for-profit schools take on more debt than public and private college students. And 10 years after graduating, for-profit graduates make on average $4,000 less a year than their public college counterparts. So federal student loans subsidize for-profit schools that churned out useless degrees. In the last few years, the federal government has started to recognize this fraud and has forgiven billions of dollars of loans held by students who attended for-profit schools. And we'll link a resource in the chat that kind of goes into more detail on where we sourced a number of these infographics, because they go a little bit more in detail.
So there's a difference between making good choices and having good choices. The former assumes a level playing field where everybody has access to resource, knowledge, and power. And the latter recognizes that our choices are often shaped by past and current institutional policies and practices. When so many of the options are limited and your mental bandwidth is heavily taxed, good decisions aren't always easy to come by. The way we're able to recognize those differences is by learning about our history and how it affects people's lives now.
So now we're going to do a discussion. You can see the prompts here on the screen, and we want to look and discuss like specifically what ways we can talk about wealth, how it looks, and ways to broaden it. And to set that up, I wanted to provide an example or a framework of what a counter narrative looks like. Specifically coming from a recent session that we partook in with Tahoma Institute, which is a all-female Indigenous group of practitioners who does social justice and DEI training with a focus and lens from the Indigenous community. And in their final session, in which we were looking at Native economies, one of the things that was framed specifically within there was that what wealth looked like and what it looked like, not just in definition, but in practice in communities. And so in indigenous communities and here in the US, wealth can be thought of in several different ways, but primarily one of the things that was shared by a tribal member who was a facilitator of the Salish Kootenai tribe was around the experience of gift giving or giveaways as a way for status to be giving to individuals. And that status was more about what you were giving versus what you had as far as commodity or exchange in relation to others and to the most. So it wasn't, what you had or having the most. It was the most that you gave in practice that was considered wealth. So with that example, wanted to frame one example what it could look like in reflection from something that was really recently shared with us, and then open up an opportunity for us to have a discussion with these particular two guiding questions and call it into our communities. And as always, I think we're going to stay as a large group here, so folks can feel free to come off mute and share out loud. Or as always, you can use the chat as a space to share.
Yeah, and I'll just name, we're kind of like pivoting here all of a sudden, right? There is some reality in the way wealth is calculated and defined and used to track financial progress, which is, we talked about the net worth calculation. But the hope is that's not everything, or that's not the end of the goal, right? Is just to say, are you progressing in your individual wealth? So it's okay to take a few minutes to kind of reflect. This is a pivot to say, what else, right? So if the status of wealth inequality is pretty bleak, so not ignoring that, but also what could we think of as more inclusive definitions of wealth? And so if people have examples from their community or ways that they have practiced bringing in a broader definition of wealth, that's kind of our pivot here. And we decided not to do breakout groups since being the last one, feels great to hear from people in the big group space. So yeah, in the chat or unmuting is great.
Hey all, this is Trista from Goodwill. One of the things that I talk about when I do an orientation with people about the IDAs is when we're talking about net wealth, that there are other things that are inherent to that individual that can't be taken away from them. Possibly their education, their self-confidence, things that they've invested in themselves that that is self-worth rather than net worth. So it doesn't have a monetary value, but it has just as much importance.
Thank you for sharing that, Trista. I wanted to read from Natalie Mitchell in the chat. Natalie shared that in our indigenous and Mexican culture, there is wealth value placed in a person's age, meaning that they have the most to share with the family in terms of values, life lessons, stories, experiences, social connections, recipes, etc. Thank you, Natalie, for sharing that. Suzanne is in agreement with Trista around self-worth, and Natalie around having a hard time understanding how this translates to financial wealth.
Though I think this is Suzanne, sorry. I think Sven's point is actually good, that relational capital, that ability to network and make money within your relations, maybe potentially using your age or your status to be able to increase your financial wealth could be an answer to my question.
Yeah, that's an excellent frame you called in. Abby put in the chat, lucky to be a part of communities that experience wealth through a focus on resource knowledge, task trade, and mutual community care. Thank you, Abby. Laura's raising her hand. Laura, you wanna?
Yeah, as a parent with small kids, having access to family support systems and childcare is really vital in my community, and is seen as a form of wealth, as an ability to build community and also to work and gain other financial advantages as well.
Thank you, Laura. Leah put in the chat that she thinks the point is that these are ways to define wealth that is not solely financial wealth as measured in money, or in the American dollar. That's excellent. I would also expand on the example I gave earlier and extend it to indigeneity across Turtle Island up in Canada and over to Australia. And there may be some streams of this throughout other indigenous communities. So not to monolith, but to say that oftentimes natural capital is of particular interest in the generation or consideration of wealth for First Nations or indigenous folks. And so that's basically looking at like renewable or non-renewable sources, the ecosystems, such as, quality of land, water, air, biodiversity. And also there's the fact of cultural capital, which I think folks referenced a lot in here, which exists in things that are tangible, such as maybe buildings or locations or sites or artwork and artifacts, or intangibles such as ideas, practices, beliefs, and traditions. Denise?
Yeah, the idea of gift giving brought me the idea of like passing down clothes, also called like hand-me-down. So I'm very thankful to have a daughter who has lots of cousins who are like 1 year older than her. So that has saved us so much money. It's also helping the planet with having less waste out there. So it's kind of twofold in there with the wealth for the planet as well.
I'd like to circle back, if I may, back to our very first session when we talked about, I think we talked about values and GDP and gross domestic product as the measure of the health of an economy. So we have to keep growing. And as I'm listening to you guys talk, I'm making the linkage of like the traditional mainstream definition of wealth is kind of like the definition of GDP. Like it should always kind of be growing. And so in those ways, we can kind of make the parallels that it's an exclusionary definition, because there's a definite way of thinking about what's healthy financially. But I think we might have watched a video, or I've seen a video that talked about another country called Bhutan, who doesn't measure GDP, they measure gross national happiness. And so they have different measures of what is a healthy nation, what is a healthy community, and they're more inclusive in their definition of well-being. And so that's kind of like, to me, at a macro level, like when we're measuring wealth only by finances and financial stability, it's exclusionary to the other factors that you guys have been talking about that just adds to our overall well-being. Anyways, those are just some thoughts. I wanted to bring it back to the first session.
It's a great callback, Julie. I'm going to go back to the chat real quick and pick up on some new comments that came in. Looks like, oh, excuse me. They had a couple more responses saying being rich in experience versus rich in dollars in your bank account, and that wealth of time, energy, and freedom to make the choices you want. That in our current system, that is often correlated with financial wealth. Unfortunately, it doesn't have to be. Nate provided a comment saying that thinking about net worth and what Julie said around GDP reminds him of how some jobs are not included in the wealth of GP, like childcare and other caregiving for families that doesn't bring in income, but is an important piece of lives and economy. That's an excellent point.
I wonder if anybody wants to add kind of to the second question. So how would broadening the definition change our approach to teaching financial education?
Hi, this is Leah. I think that right when we do in part of our intake is a strengths assessment, and so or a not assessment, sorry, wrong word. Review, asking people about their strengths, naming it, and just looking at those, looking at financial education. Often the goal is seen as having like accumulating the most money, and what choices do you want to do that versus we also include a discussion of values and goals of sorry, that's the door, that's my dog. Values and goals, and that more money isn't necessarily always the goal, and just really broadening that conversation of why are you engaging with finances, and what do you want with this?
Yeah, and then Sophia put a comment in the chat that in response to the second question, it would be a holistic approach that takes into account the person and not just their financial information.
I just want to say, this is Suzanne. I'm actually kind of having a hard time with this. And the reason I'm having a hard time with this is because we started off this presentation talking about finances. We end talking about finances. I would love to live in Bhutan, where we have a society that actually does look at other things besides financial wealth. But the reality is that the way that we approach it in our society right now really is about the numbers. We talk about goal making, but even in, the IDA, we talk about goal making as a finance piece, not as a money piece, not as a, status or education or any of the sort of larger pieces that we're talking about right now. So I'm having a hard time trying to figure out how I'm going to put this into the classes that I teach.
I appreciate you, Suzanne, for calling in that tension. I think that's healthy and natural. And I think oftentimes as we do this work and we think about equity and we think about systems, right? It's changing and shifting systems, and that's hard. You don't always know what it looks like. And that's okay. It's okay to feel the ways we feel. That's okay. Having a responsibility as practitioners and trying to be within the system while changing the system is just a healthy place of tension. And so not to say I have an answer or a response, but to say I appreciate your vulnerability and calling that into the space, and would open up to other folks who may feel the same way. If there's any thoughts around that, or similar feelings or questions that folks would want to also bring into the space. And thank you, Suzanne.
Yeah, I think the reason we're asking it is because it is a hard question. We don't have the answers, but part of it is just bringing into, I think, the call back to values as a beginning point to financial education, and that even in the example of get an education because you'll make more money, that can be a myth, right? It's not always a 1-for-1. Or buy a house, you'll have wealth in the future. Also not necessarily true. So sometimes it's just questioning some of the assumptions, but also we do live in a financial system where money, as Leah said, often correlates with more free time or more safety, comfort, lots of things, access to transportation. So I don't think there's an easy answer, but that's why we're asking the question. So thanks for engaging with the challenge.
See, Sabrina put into the chat that it fits into a supportive and strength-based approach to financial education, emphasizes that folks have wealth in many other ways besides money. And that said, we're helping folks navigate the current system. And when they walk into a bank, wealth has a very specific definition. And Natalie put that She wonders if there's a way for our IDA participants to reflect and share with us all the other ways they may have grown over the course of their IDA journey that was not about the savings goal. And Leah put in there that a recent financial coaching session with a person that she was talking to about choices that person could make so that her life and her ability to get her needs met are less dependent on money. So they did that at the request of the saver. And Misty put that by broadening the definition, we would be able to shift mindsets from chasing a dollar and a price tag to things that the person feels connected to along their values and ideas of wealth, and being able to attain their chosen lifestyle. That's excellent, Misty. And Ross put into the chat that many transferable skills can come from learning about and going through the process. Which reminds me of a community agreement you often see in equity work is, in our westernized dominant culture perspective, we often focus on product over process, right? Where in this inverse, in the collective mindset of many communities of color, it's the process is more valuable than the product. And it doesn't always look the way we think it looks. And what I appreciate about what everybody's sharing and as we're wrestling with this is it's that call in, that reminder of having the ability to dare to dream bigger and to dream different and to think outside of what it is that we know and not to constrain ourselves to the box of a system or an idea that we have inherited or been told is what it is, which is tough. Any other last thoughts or comments or responses or shares folks want to make? Still got a couple minutes though.
I want to share. I don't know if what I'm sharing is like correct or not, but I figured there's no right or wrong response. So, as far as like financial education, I know that at MISA we've taken on the profit and loss workshop, which we noticed that since we do serve many BIPOC clients, a lot of those communities struggle with keeping track of their finances. So the most that we can do is teach them the financial education on how to keep track of those finances, but also let them know that it is such an important piece for them to understand their finances on their own as well, opposed to just taking it to an outside source, because it all starts with us first. And once we have that understanding, like I even speak from experience, like my mother, she has a business. I don't think that within the last few years, she's necessarily tracked her finances. And it's all about the lack of education that we have in the communities of financial educations on how to do things right or wrong. But as long as we have financial education more so introduced to communities as a resource, I think that it will be it can be much bigger and also make communities that we serve more comfortable, opposed to, well, if you don't know about credit, then you're not going to get a house, or more so, yes, emphasizing and making connections, and just emphasizing that financial education is really a resource key instead of just something that you learn overnight.
Thank you, Nancy. And with that, I'll close us out and transition us to a break. And as always, you're welcome to continue to put your thoughts in response to these two questions in the chat. As always, we don't have to close it with the activity. Everybody has different approaches and the way that time works and how we process. So if things come up or responses come up or questions come up, as always, feel free to put them into the chat. But to bring us to close on this particular block of what we're working on before we go to break, when wealth is limited to the mainstream definition, the process, priorities, and solutions in addressing the wealth gap center dominant approaches that reinforce and perpetuate the norms, expectations, and values entrenched in whiteness and extractive capitalism, or another term I've heard it called is racist capitalism. So with that, we'll take a break. We'll take about 10 minutes and we'll see you back here at 11:10 and we'll continue.
All right, I'm going to invite you all back as you're able to. We are pivoting after the break towards our last topic, which is insurance. And so we knew that we at some point wanted to bring in the Department of Business and Consumer Services and the Department of Financial Regulation. They have acronyms DFR and UCBS. And because they offer a lot of support in understanding and regulating financial systems. And so I think insurance ended up being the topic that felt most aligned to try and bring in some expertise in Oregon. And so we are lucky to have Lisa Emerson. We were going to have one other person, but she had an emergency that she had to attend to. So Lisa, thank you for stepping in. I'm gonna put you on spotlight as well as myself. But could you introduce yourself? We actually can't hear you, unfortunately.
Okay, how about now?
Yes, we can hear you now.
Okay, here's the challenge. And pardon me, but I'm gonna go with this because my microphone is working for you. But my audio for all of you, I cannot hear. And it's probably because I haven't logged into Zoom, so I apologize. So I'll just kick it off and I'll kind of follow the cues from you, Luke, and in chat or whatever. But yes, thank you for having me today. I'm Lisa Emerson. I'm a senior health policy advisor. Actually, I recently got a promotion, which I'm really pleased about. So that's my new title. And I work for the Department of Consumer and Business Services, as you mentioned, Luke, in the Division of Financial Regulation. So the Department of Consumer and Business Service is the largest regulatory insurance agency in the state, but also one of the largest consumer protection agencies. So my work is within the Division of Financial Regulation, which oversees insurance and financial products. Carla Martinez, sorry that she could not be here today. She is I'm going to use the acronym DFR for the Division of Financial Regulation, but she is the consumer liaison for DFR and leads these types of events, education events for us, and invited me to come along to speak about insurance in general. But I wouldn't want to miss the opportunity to cover the material that she had, which is talking about the work of DFR, including outreach and education. So I'll start there and then we can move into more of the questions about insurance regulations, the other questions that you had posed for us, Luke. So I won't go too far off script so I can cover this important information that Carla wanted me to cover today. So I already introduced what the department does, but basically to refresh, DFR regulates insurance and financial products and it's and licensees, so insurance companies and insurance producers, investment brokers, and such and so forth. They also regulate programs around student lending and drug price transparency. Our office licenses and regulates businesses, insurance, and financial services by conducting exams, investigations, taking enforcement actions when necessary. We also assist consumers. That's a lead part of our work, and that we assist consumers by taking complaints to investigate them, resolve them hopefully as favorably as possible, to ensure that they are also treated fairly. We monitor and examine insurance and financial institutions to ensure that the companies are financially stable. We review and approve insurance policies and rates to make sure they comply with legal requirements and ensure that that rates are not excessive. Our division policy advisors, such as myself, follows legislation in the insurance arena. We facilitate formal rulemakings with a formal process that has advisory committees that participate when required by legislation, and also when it's within the director's authority to adopt rules to administer the insurance code. We release guidance to our licensees. We advance policies to protect Oregon consumers. The education and outreach team is charged with educating Oregon consumers around the products we regulate so they can make informed decisions when using insurance and financial services. All right, thank you. Our advocate team, which is the outreach and the advocacy and outreach team, have advocates that serve as division's front line for observing and documenting industry behaviors. They also handle inquiries and complaints from consumers about their insurance or financial products. The advocates are subject matter experts. Many of the advocates come from industry that we regulate. In 2022, our advocates helped over 13,000 Oregonians with their concerns and that resolved nearly 5,000 complaints. Help is available Monday through Friday on the helpline, 8 to 5. And I have the phone number, which I could also put that in the chat before we end, so you have that. And the outreach and education team partners with groups like neighborhood partnerships, teachers, other community-based organizations, business associations, local government, tribal authorities, and event organizers to get the message out to the community and provide information to help consumers make well-informed decisions about finance and insurance. We also coordinate public service announcements through TV and radio, social media. Our team is available at no charge to provide training, participate on panels, and host a table or at events, or give presentations to your groups in English or Spanish. We can customize topics to meet the needs of the audience. We also have a number of free consumer guides available on many, many topics. You can check out that information on the DFR outreach page by clicking the green outreach and education button on the home page, and you can find more information on our topics and publications around insurance, home, renters, auto and health, finance, budgeting, credit, managing debt, ID theft and scam protection, investing, student loans, disaster preparedness. Insurance and finance is very deep and wide and very complex. So when in doubt, please turn to our division to be a resource. And if we don't have the information, we will make connections to federal, state, and local partners, local governments, and nonprofits. DFR, this is really important that Carla wanted me to mention, that DFR provides sponsorships to organizations that engage in the financial empowerment work and serve underserved communities through our statewide outreach sponsorship program. The program sponsors 5 organizations up to $25,000 annually with each award. The goal of the program is to collaborate with trusted community partners in delivering financial education to consumers and underserved communities. The program helps empower consumers to make decisions about insurance and other financial services that are best for them and raise awareness of free services or resources offered by the division. Oregon organizations can apply to receive one of these 5 sponsorships contracts. We are accepting submissions for grant proposals until September 22nd, 2023. Preference will be given to nonprofits, public schools, public charter schools, and tribal entities currently conducting financial empowerment work in Oregon. So that timeline is a bit short. Some of you may have already been aware of it, but if you need assistance, don't hesitate to reach out to me, and I'll make those connections with Carla to make sure we, make that a priority. So that's kind of an overview of what the division does in the Department of Consumer Business Services. And also about certainly the outreach and education team. And if as time allows, I'm happy to go ahead and answer some questions about the regulatory aspects of insurance.
Yeah, I'll
Just a
put the,
moment.
I don't know if you can hear me, but I'll put the questions we're prompting for you in the chat.
Okay, so how do insurance companies make a profit? Why do they need to be regulated? Let's get up here. So as far as how do insurance companies make a profit? So basically by pricing and assuming a risk. So revenue models specifics vary among insurance companies, property insurance companies, and financial guarantors. The first task of any insurer, however, is to price risk and charge a premium for assuming it. So the 4 points are charging premiums in exchange for insurance coverage, ensuring the premiums are greater than any future claims, which is known as underwriting profit, investing in premiums while they are not being used to cover claims, which is known as investment income, and getting a lot of policies, so market share at the lowest possible cost or acquisition, and keeping those policies active for as long as possible, which is called retention. That's kind of a textbook answer, but that's kind of what I thought might be a good starting point. And as far as why they need to be regulated, there's federal law for this purpose. So insurance is regulated by the states. This system of regulation stems from what's called the McCarran-Ferguson Act of 1945, which describes state regulation and taxation of the industry as being in the public interest and clearly gives a preeminence over federal law. Each state has its own set of statutes and rules, and as does DCBS. So DCBS is the overarching agency over the DFR, and our director is also the insurance commissioner. The DCBS director is also the Oregon Insurance Commissioner by appointment by the governor and the legislature. His name is Andrew Stolfi. And then within the DFR, which is a division of financial regulation, we have an administrator, and his name is TK Keene, and they work together to oversee the regulation of insurance and finance. So state insurance departments oversee solvency, market conduct, and to a greater or lesser degree, review and rule on requests for rate increases for coverage, among other things. While the regulatory process in each state varies, there are 3 guiding principles that every state's rate regulation system has. That rates are to be adequate, to maintain an insurance company solvency, but not excessive, not so high as to lead to exorbitant profits, nor unfairly discriminatory. Price differences must reflect expected claim and expense differences. I'll kind of stop there. Go back to the audio.
Yeah, thank you. I'm just going to keep posing our questions in the chat, but I'll also open it up for people in the audience to ask questions. Just sort of to frame this, we both want to know what DFR does and how they support, but also how the system works, right? Part of financial education from our perspective is understanding complex systems, so then we can help navigate and help our clients understand those systems as they make those choices. So, we're really in this next question looking at historically, there are a lot of, race-based or gender-based or other, things that were used to include or exclude. So I don't know if you want to talk a little bit about, in general, how, what are things that are no longer allowed to be considered. After your talk, we'll talk, I'll mention that Neighborhood Partnerships has for a while been pushing an effort for the state legislature to disallow credit in insurance premiums, and that has been a struggle to pass. So insurance is allowed to use a credit score in determining a premium. It's an example of what they can use. So I don't know if you want to speak to what they can't use and how that may have disproportionate impacts when you think about access to insurance.
Okay, certainly, and I hope you can hear me now. Hope I clicked the right button. Okay, good. So yes, what I'll go over is essentially the statute that regulates insurance companies and their conduct. And it's basically an anti-discrimination statute that's within the insurance code, and kind of that might make clear what kind of activities are prohibited, and then we can kind of go from there. And this is in the arena of property and casualty insurance, which is, for example, auto and homeowners, and then also in health. So basically, a lot of times we mirror the protections afforded by the federal government, as in the Affordable Care Act. So it's also codified in the Oregon Insurance Code. So let me just get my notes up here. All right. So generally, insurance rates are based on an assessment of risk for providing insurance. So risk of loss in exchange for providing insurance for a premium cost. Rating factors can include driving record, say insurance claim history, how many claims and for what. Age can factor in, to say auto insurance rates. Gender to the point of male or female can factor in. Cost of replacement for, say, a car, home, whether you own or you rent, the household contents value. So those are some factors that can be factored into assessing risk and assigning a premium. In an effort to prevent disparate impact on historically marginalized communities, DCVS has proposed several times, with the support of the governor, auto rating fairness bills. And like, as you mentioned, Luke, a lot of non-advocates in the community also help bring forth legislation to protect consumers. And so it's kind of a group effort. And so the auto rating fairness bill has been proposed in past legislative sessions. And in the 2023 session, House Bill 2920 in the 2023 session was introduced, but unfortunately was still in committee upon adjournment of the session in June. We hope it will be reintroduced in a future session. The bill would have direct insurers to consider only specified information in determining rates for motor vehicle liability insurance policies. It would prohibit insurers from considering other specified information in determining eligibility, rates, or premiums for motor vehicle liability insurance. It would permit insurer under very specified circumstances to consider the abstract of an individual's non-employment driving record when evaluating an individual's application to obtain or renew a motor vehicle liability policy. It would prohibit an insurer from using credit history to determine eligibility, rates, or premiums for motor vehicle liability insurance. This would have been operated in 2024. And for more information, that bill is more detailed on the Oregon Legislative Information System. So that, again, that's House Bill 2920. And while it was unfortunately in committee on adjournment, we're hopeful that it will come back in a future session. Whether that'll be the short session or the next long session, I don't have that information. So my arena is of a specialty is health insurance. So I am kind of speaking from notes about the area of property and casualty, but that's an important thing to point out. Another consumer protection bill involving homeowners insurance is House Bill Senate Bill 882 that DFR proposed and supported the bill, which is called the Wildfire Insurance Bill. This bill strengthened consumer protections for homeowners insurance policies in the event of wildfire disasters. It creates new requirements for contents of notices, requires insurers to consider wildfire risk mitigation actions that consumers take or policyholders take, and extends the timelines to rebuild homes or other structures and replace personal property if certain requirements are met. So those are some of the positive things that have happened, or one that has passed and then one that we hope passes in the future in the area of property and casualty insurance, and in pursuit of equity. Let's see. So back to the statute. So the statute that protects all insurance consumers is the trade practices statute. And that is ORS 746.015, discrimination, noncompliance, and hearing. And so point number 1 is that no person shall make or permit any unfair discrimination between individuals of the same or equal expectation of life, or between risks of essentially the same degree of hazard in the availability of insurance, in the application of rates for insurance, in the dividends or other benefits payable under insurance policies, or in any other terms or conditions of insurance policies. That's kind of the overarching non-discrimination law with respect to the insurance that the division regulates. One area that I think you all talked about in the earlier part of this meeting was the issue of historically what was referred to as redlining. And in the insurance industry, particularly in property casualty insurance, so that's auto and home, at least with respect to auto and home, I believe this addresses that that is prohibited activity. So one other part of the non-discrimination statute is that property insured or persons insured against liability arising out of the use or control of real or personal property other than motor vehicles is comparable in other respects to exposures to the peril insured against, which is the risk insured against, shall not be deemed to be of different hazards solely because of the geographic location of the property or the place of residence or business of the person to be insured. So that is another law that protects all insurance consumers. And then last law I'll touch on that is important to prevent discrimination is in 2019, DCBS codified Section 1557 of the Affordable Care Act into the insurance code, which states that Section 1557 of the ACA prohibits discrimination on the basis of race, color, national origin, age, disability, or sex, including pregnancy, sexual orientation, gender identity, and sex characteristics in covered health programs and activities. And that is the covered health and programs or activities of the Department of Health and Human Services. So everything under the umbrella of HHS is subject to this federal code. And again, that was codified into Oregon statute in the non-discrimination statute 746, chapter 746, and 0.021 is discrimination under health benefit plans, except as otherwise provided for in the insurance code. An individual may not, on the basis of actual or perceived race, color, national origin, sex, sexual orientation, gender identity, age, or disability, be excluded from participation in, be denied the benefits of, or otherwise be subject to discrimination under any health benefit plan issued or delivered in this state. So those are some key concepts that I wanted to share with you today.
Thank you, Lisa. Can you hear me? Okay, I think our last, we're just gonna wrap up a few, maybe 2 more minutes for you to finish on what do you think the role of community partner, so, you know, this meeting has about 30 staff from organizations across Oregon who offer financial education or financial coaching. What is our role in supporting clients, you know, you as somebody that really understands the insurance industry as we help people navigate insurance?
Thank you. Yeah, that's a really critical piece to emphasize of us coming together today and you inviting DFR to participate. I think the main message to you know, IDR participants, and the community partners that are helping to facilitate IDRs, but also just generally financial and insurance literacy overall is really complex and complicated. And I think that we want to communicate and keep the lines of communication open and make it easy to communicate with DFR through the consumer advocacy team and outreach team. We have a lot of different educational information on our website. We put on different types of education classes. If we don't do them personally, we can connect you to other great resources, including, for example, neighborhood partnerships for a topic that is, very specific that we prior to this didn't have a ton of knowledge about. So this is where community partners are critical to be messengers to the community about where to seek official information, how to get involved in the development of the laws and policies around insurance and finance. We can't know it all, but knowing where our resources are is key. And I think that those community partner sponsorships is a real important step that the division has taken in that direction to help support community partners to do this important work. So I see that as an important thing to emphasize. But I'm open to any questions, from community partners that are on the meeting today or participants that have any questions about our other resources that we can offer.
Great. Yeah, thank you, Lisa. Can you put your email in the chat? If people have questions, they can reach out directly with you. I put the link to the DFR outreach and education, which does have the information about the opportunity, the grant opportunity you mentioned. And, as we kind of pivot to finishing out, I'm going to put in just a Google Docs link it explains a little bit from neighborhood partnerships. We have some advocates in our organization that have been working on the auto insurance. It talks a little bit about, as we look at racial disparities in credit access, why it's problematic for insurance to consider credit, and how that would perpetuate inequity through not just home buying rates or car buying rates, but actually insurance rates. We have a couple other policies that were highlighted by are not specific to insurance, but just when we think about addressing racial wealth gap through policy. Some other ideas are you all should be seeing the Opportunity to Serve Act coming up. It sounds like it was referred to a constitutional amendment for voters, which is really saying, can we pay legislators a living wage to do that job so that there is greater access for community members to be legislators and not have to balance a very low salary or other jobs along with being an Oregon State legislature. And then the third one that was highlighted is the Joint Task Force on Addressing Racial Disparities in Home Ownership, which people refer to as JARDO. And that is a task force that is looking at what's the role in home ownership solutions or what we need to invest to close those disparities in Oregon. So that's just a little summary of trying to bring it some policy perspectives to the topic, and also as we think about financial education being more than just educating, but also potentially getting involved or spurring change at a broader systemic level. So I'm going to share my screen again here. If you'll give me a second. So again, thank you to Lisa for coming. Appreciate your time and insight and the work that you do. Here's the legislative advocacy, kind of the highlight that you'll find in the Google Docs. As we shift to thinking about wrapping up this session, we do want to thank you for joining us. Many of you who have come along to a bunch of sessions over the last couple of years. Our goal is really to look at how can we learn more about economic literacy within these topics, think about why it's a critical piece of the education that we offer to IDA savers, and join us in thinking about what we need to do differently within our economic systems. So while it's great to work with clients that are reaching goals, what would it look like to get to a point where the work that we do is not as needed, that there aren't as many people in situations where they're struggling to make it financially or build those assets that we are supporting them in. So over the last couple of years, we have talked about the 12 topics. They've been 2-hour sessions. There are recordings of the previous sessions. And there's a lot of content we couldn't include, of course. And so we think of this as maybe the beginning of an ongoing journey, maybe a circular journey in thinking about this work within a community of practice. I want to particularly thank Julie, who has been kind of with us through the last 3 years. We did some economic literacy matters sessions first, and then we did these 12 topics. So, you know, a virtual props to her, really diving into topics, thinking about how do we look at some particular pieces in a topic that informs us on the history, looks at the impact, and just bringing her experience and wisdom. So thank you, Julie, for all your contributions to these sessions. We are going to wrap up with a video and then a short discussion, and then we'll be done. So I'm going to play this video.
Imagine a microscopic-sized ladder contained in the part of our brain that will label our subconscious. The ladder of inference, which was first proposed by Harvard professor Chris Argyris, is the basis of this model. Every time we interact with someone, that experience enters the ladder at the bottom. That same experience zips up the ladder in the blink of an eye, exiting at the top. This process happens thousands of times a day without us knowing it. Let's focus on what happens on each rung of the ladder. On the first rung, we have the raw data and observations of our experience. This is very similar to what someone watching a video recording of our experience would see. Moving up to the second rung, we filter in specific information and details from our experience. We unknowingly filter based on our preferences, tendencies, and many other aspects that we believe are important. Onto the third rung, we assign meaning to the information we have filtered through. This is where we start to interpret what our information is telling us. On the fourth rung, a very crucial thing happens. We develop assumptions based on the meaning we created on the previous rung, and we start to blur the distinction between what is fact and what is story. On the fifth rung, we develop conclusions based on our assumptions. This is also where our emotional reactions are created. On the sixth rung, we adjust our beliefs about the world around us, including the person or people involved in our experience of the moment. On the seventh and final rung, we take action based on our adjusted beliefs. Still with me? Great! Let's take a real-life example and run it up the ladder to see how this all works. Have you ever been cut off in a parking lot, signal light on, as you steer toward your coveted spot only to slam on your brakes at the last minute as someone pulls in front of you and steals your spot away? Imagine that experience and notice all of the data and observations landing on the first rung of your ladder. Now let's watch what we pay attention to on the second rung. Who cares that it's sunny out and the birds are chirping? The 50% off sign outside of your favorite store is meaningless. You filter in the sensation of your grip tightening on the wheel, you feel your blood pressure rise, you hear the squeal of your brakes, and you notice the expression on the face of the other driver as he pulls in front of you and quickly looks away. Time for our third rung. Ever since you were young, your parents taught you the importance of waiting in line and taking your turn. You live and die by the rule of first come, first served. And now this guy has just stolen your spot. What gives? Up to the fourth rung we go. Watch closely as our assumptions take over and our story creates itself. That stupid jerk. Didn't his parents teach him anything? How could he not see my signal light? He must never pay attention. Why does he think he's more important than anyone else? Jumping quickly to the fifth rung, we conclude that this guy is heartless, inconsiderate, he needs to be taught a lesson and put in his place. We feel angry, frustrated, vindictive, justified. On our sixth rung, we adjust our beliefs based on the experience. That's the last time I give in. Next time someone tries to cut me off, tires will be smoking on the pavement as I squeal past them into my spot. And finally, our last rung, we take action. We back up, pull up behind his car, honk our horn, and roll down our window to scream a few choice words his way. Now, imagine, he walks over quickly, apologizing. His wife, who is almost due with their first baby, called him from inside the mall to say she is in labor and needs to get to the hospital immediately. We are momentarily shocked, apologize profusely, and wish him luck as he rushes toward the entrance. What just happened here? What changed? Why is this so significant? In our parking lot example, our beliefs were short-circuited by the ladder of the other individual. My wife is in labor. I need to get there quick. There's a parking spot. Phew! Oh, geez, I cut someone off. I better apologize quickly so they don't think I'm a jerk. But what if we were able to short-circuit our ladders ourselves, proactively, by choice? Guess what? We can. Let's return to our unique human function of free will. Next time you notice yourself reacting to your experience, pay focused attention to your ladder. Ask yourself what beliefs are at play, where did they come from? What data and observations did you filter in as a result of your beliefs, and why? Are your assumptions valid and supported by facts? Would a different set of assumptions create different feelings and result in new and better conclusions and actions? We all have our own unique ladder. Be mindful of yours and help others to see theirs.
I love this tool. It's such a great model or a mental model for us to kind of start thinking about the way we know things and the way we think about things. But I want to, Suzanne made a comment earlier about like, do you have any specific modules or lesson plans around economic literacy that we can take off the shelf and use? And the answer to that is no, not really, because the tool of understanding economic literacy is more of a lens. And certainly we want you to be able to introduce some of these historical facts into your conversations with your participants. But learning about past policies and practices helps inform our interpretations and assumptions. And they can help us short circuit the harmful mainstream narratives that keep us overly focused on individual effort rather than acknowledging and addressing existing systematic barriers. The ladder of inference is a useful tool to slow down our thinking, to be able to identify false assumptions and biases that can negatively affect the way we approach our work and our participants. And so while it's a tool that we're introducing very briefly, it's got so many applications in our lives. And so I encourage you to, give more consideration to the tool and how you might integrate it into your life. It can be very helpful within organizations and certainly in your interactions with the people, the participants that you work with. For those of you who've been around a while, you've heard the swimming analogy. Imagine that you're trying to teach someone to swim. Most likely you start off in a controlled environment like a shallow pool with clear visibility of the bottom and the sides of the pool. You teach basic water safety and the mechanics of floating, how to stay calm in the water, how to sail underwater, and the beginning stroke and treading water. Teaching these steps is not unlike teaching basic financial education. These skills are essential to our success in the pool, but they fail to acknowledge that swimming in a controlled environment is vastly different from swimming in a river where the swimmer has to contend with powerful currents and various obstacles. Our financial lives occur not in a controlled pool, but a river where wage stagnation, tax policies, shifts in labor trends, and differential access to wealth building tools and credit make it harder for many people, particularly Black, Indigenous, and other people of color, to successfully stay afloat. Teaching financial education without incorporating economic literacy erroneously emphasizes that financial wellness depends solely on individual actions and fails to acknowledge pre-existing systemic, economic, and racial inequities that perpetuate severe income and wealth disparities. A functioning democracy with an economy that works for everyone requires an informed and involved electorate. Solely teaching financial education without the broader historical economic context we live in also reinforces the status quo. Understanding how past and present policy choices have created the current unjust economic system enable all of us, facilitators and participants, to engage in the advocacy required to ensure long-term financial security for ourselves and our communities. We also have to remind ourselves that each saver has their own economic, political, and socio-cultural context, significantly influencing their financial situations and decisions. Throughout these sessions, we've emphasized that we're trying to create new neural pathways that diverge from the well-worn path. Like learning a foreign language, you must integrate your new learning and put it into practice. We know that it's a big ask to put this into practice in financial education, but without it, we fall short of our end goal of supporting more financially resilient and empowered households and communities.
And so with that, in closing, we want to invite everybody back to a larger group discussion around the following guiding question, which is, what are some practices you can implement to support new neural pathways of thinking? So take some time, depending on how your process is. You can write some things down, obviously always using the chat, or pop off of mute and share your response in the virtual classroom. But for right now, just want to open up the next 6 or so minutes for folks to consider this question, and when ready, and those willing, feel free to share verbally or within the chat. Right. Looks like Natalie posted in the chat perhaps a similar version of how we started today, with the basic facts of how and why some communities are worse off in terms of financial wealth and access to capital, and to help folks see that this is not, emphasize the not all caps, just an element of personal financial failure or ignorance, but very real systems in place contributing. Thank you, Natalie. Continue to hold space. We got about 3 more minutes, and then we'll close out. We'll talk about some things that are coming up and invite you to those. But yes, still have a couple minutes, so you can hop off mute if you have any final comments or thoughts you want to contribute to the large group discussion, or in the chat. All right, looks like Victory posted in the chat to not make assumptions prior to meeting with a new or existing saver about their ability to achieve goals and to come up with solutions regardless of their barriers. Thanks for that contribution, Victory.
For me, it's helpful. One thing Julie brought in the slide earlier is, conflating making good choices with having good choices. So am I asking, is this person making a good choice, or, reframing it maybe more to like, what are the choices that this person has available to them? So yeah, less about their choice and more about what are the choices available.
Suzanne posted in the chat that she thinks the idea is to offer enough information that the assumptions people may have are better informed. For instance, talking about wealth from a more holistic approach, we can help participants potentially not blame themselves for their circumstances. Thank you, Susan. That's an excellent point. And I know a big aspect of what we try to implement by focusing on the systems and not the individuals in punitive ways when we talk about systemic oppression. So I think that that's a great one-on-one micro approach to do the work that we get to do. Then put a comment in there saying exploring alternatives to traditional wealth building based on what the individual client has access to, like community, family, relationships that could open up opportunities, and reframing his own thoughts and assumptions on pathways to wealth to be more flexible when helping clients plan. Transition us towards close, and if folks have some thoughts and want to put them in there, great. I would share and just kind of say, for me, I think madly aligned with everyone. And I think for me, it's very simple at this point, and how I try to show up is remembering my come from, but always trying to center people and remember that we walk alongside people. And so the challenge is always, what does it look like to walk along somebody in their journey, right? Versus trying to guide them or lead them or follow them, but to really walk alongside them. So that's really metaphorically how I try to approach the work at Current, which is a struggle, but I try to do better. So thank everybody for sharing and being in the space, and the opportunity to learn and grow with each other. It's been a blast. Shout out Julie. You awesome, Julie. Appreciate you. And looking ahead, we just posted the eval in the chat. So as always, please take some time to fill that out to provide us feedback and ways to improve. And also we have a couple more questions that allow you to think specifically about the individual ways to impact your practice and ways that maybe your organization can also impact their practice as it relates to financial education with an equity lens and how we show up to serve people. And want to invite folks to join us, if you haven't already registered, for the upcoming IDA Day in October 19th. And we have a unique opportunity where we're trying to pair the core DEI training series. So for those of you who may have completed that in the spring or may need to still complete one of the two parts, we'll be offering the whole session as a one and done on the 18th. And we're pairing it with IDA Day. We'll be in Salem at the Holiday Inn Conference Center, and NP will look to cover travel and lodging reimbursement up to 2 IDA staff. So we posted the link, or Luke posted the link in the chat. So definitely, check that out, join us, send some folks our way. And again, if you haven't got a chance to do the core DEI training, please join us for that as well. The 16th, which is coming up, is the designated registration day. Well, we'll call it a medium hard deadline for the hotel. We reserved a block of rooms at a rate. They can't necessarily guarantee the rates beyond that, but they will hold blocks. So the rate that we have in play that breaks discounts. They're softly tying it to that, so the sooner the better. And then for us as well, because we're providing T-shirts, we're doing that at first come first serve. So those who can register earlier, better than later, have a better chance of getting a T-shirt. So yeah, with that, appreciate you. Hope you have a wonderful afternoon. Thanks for hanging out with us, and as the kids say, peace out.
Sapapeo zedeho, sapapeo zedeho, sapapeo zedeho, sapapeo zedeho, sapapeo zedeho.